Tobias, can you be a buyer of stocks on this beautiful Wednesday morning?
It's a little bit more troublesome at these levels, and markets have come back pretty sharply on legitimate reasons, including tremendous stimulus both from the Federal Reserve as well as from the Feds or from the government through the CARES Act particularly. But we've also seen the reopening of the economy. We've seen better news on the healthcare front in terms of less hospitalizations, less deaths, more better treatments, hopes on vaccines. All that is fine. And what I call FOMO has kind of played in, which is institutional investors' fear of missing, or not out, but rather fear of meaningfully underperforming. So as markets go up, they have to participate, and everybody focuses on the technicals as opposed to some of the fundamentals. For example, how's the unemployment issues going to play out over the next 6-9 months? And it is going to be a more difficult economic period.
Tobias, you touched on something really important. We see a price move, and there's always a temptation to find this neat fundamental narrative that fits it. Are you saying this is just very technical? It's a position squeeze, it's momentum, it's the fear of missing out, the fear of underperforming, as you've put it as well?
So, look, I think, again, there are some true fundamental backdrops to it. I think probably the best argument I have heard from investors is that companies are making structural change. They're learning how to work through the pandemic-induced virtual reality that we're kind of enduring. Over 2.5 months, companies have really sought out the efficiencies, and they're reacting to it. So there are going to be some structural changes that therefore provide better margin opportunity for the companies on the outside. The problem is that those structural efficiencies also mean those jobs don't come back as quickly and creates kind of a demand problem. Look, we think the 40 million numbers are too high in terms of the reported claims, simply because there's a number of duplication. People who had signed up weren't sure if they signed up correctly, submitted another claim, and you're seeing certain states coming out and telling you they're duplicates. So maybe let's say the number's 30 million, 32 million, and let's even say half of those people can get back their jobs by year end. That's still another 16 million people who don't have their jobs. And it's going to be problematic in terms of top line activity for corporations. There are certain industries that are enduring this extraordinarily well, and there are certain ones that are far more damaged, because what's really happened is the pandemic has accelerated certain trends that were kind of already underway. So the demise of brick and mortar retail has increased rapidly. The trend towards telemedicine has also increased the other way very significantly. So those are some of the things that are changing secularly. But again, I think companies have really learned how to work through this, and it is a proper argument. The question is the market moved too much? And our sense from our panic euphoria model, which is now flashing euphoria again, is suggesting almost an 80% probability that markets will be down in the subsequent 12 months as opposed to up.